Hi, this is Dawn Marie here, and I'm making this little video about legacy planning, which is an area I've been working in lately, which has been really exciting for me to learn about and try to figure out how to share with people. As I've been using the concept for the past 4 years, I've seen the benefits that have enriched my life. And so, wanting to share that profound effect. My parents right now are working on recreating a policy that they started 4 years ago and then weren't able to keep up with because of funding that wasn't there as they had planned it to be, the contributions they'd hoped to make. So they're wanting to reinstate it to get back some of those benefits that they had had before. Basically, the idea of turning your debts into future wealth. And that's kind of where I got started with my policy. I've got one for my personal use, my family as well. And as I've been looking at theirs, I kind of created some scenarios of what it would look like. What if I did this? How would this work? And it's been super exciting. I haven't really looked into a policy before that would have more than one contributor to it. And as I've been going through how this might work, seeing the greater benefits to it being like a family powerhouse banking policy, more like a credit union than a bank because of the stability that comes from having more people. So basically the plan would be to get a holding account that would have to be managed by the holding account manager, whoever that might want to be, someone who's good at math and keeping track of things. So my plan would be to collect into this holding account for the next 2 months, being March and April, and then actually reinstate the policy in May or June. And so we'd already have it in reserve so that it could be somewhat of a fluctuating amount, what was being held there, based on, I've got these contributions in that I put on my projections or my how would it look kind of thing in percentages of the full contribution that this policy has available to it. And I'm not talking about this for the point of trying to sell you on the idea of life insurance or buying something from me. I'm talking to you about it so that you can understand an opportunity and make a decision based on understanding rather than on not understanding. So, if I can explain it well enough, I want you to be able to know if this is right for you or not. It's basically the idea here. I don't know if I can get to that point, so I might have to meet with people individually who have questions as I am going through kind of how this would look. It might be more confusing than anything, but at least it's something more to go off of. I hope it's helpful. So anyways, the family banking concept is something that has basically 3 principles that I draw from. I'm creating a family paradigm of stability, positive growth cycles, and preparation for the future that can go into future generations. And the biggest reason I'm doing it is for the concept of, as a parent, I want to help my children. I mean, because if you think about it, the economic future our children are growing into can be somewhat alarming, and the power of family in helping to create stability in an uncertain, crazy, unpredictable, risky, changing world can be really powerful. And as I was putting out this projection, I could see that even to a greater degree when the policy has many members, like a credit union rather than just a bank. So part of that is having that holding account, and I was going to have it be, it's it's round numbers if I do it in 10 payments a year instead of 12. So I was going to do 10 payments a year and have 2 months of the year be a payment holiday. And if you had decided to contribute, like if you did 1%, this would be, I was thinking like one of my kids might want to contribute 1%, which would be $25 a month. That would be $25 a month, 10 times of the year. 2 months of the year you'd have off. Or even if they wanted to do 25, but they didn't make it all the time, maybe they might make half the amount 1 month, or maybe they might, get really busy with a job and be able to make 3 months and then wait for 2 months and then make another 3 months and wait for 2 months or whatever. The holding account kind of evens it all out in the long run of how it gets paid. As well as maybe someone might take more payment holidays than 2 months, and that's okay. Some people might take, only 1 month payment holiday. In the end, this holding account hopefully would even out whatever happens. And basically your percent would go off of the percent of the total premium paid is also the percent of what you would receive when the policy came to fulfillment. Whether that might be 10 years down the line, or whether it might be 5 years down the line, or however far down the road. But in the meantime, the purpose of family banking is having that bank or that pile of money available for you for collateral, so that you don't actually spend your money when you go to make a purchase, but you use it as a collateral for financed spending. And normally financing is the wrong way to go, but when it's your family bank financing you, they get the reward for doing it as well as you, and it creates a cycle. So what happens when you do finance is you pay back what you've financed with interest, and that interest goes to the PUA rider, which is called a paid up additions, which it means that that interest increases the policy's benefits without increasing its cost. So it's like an investment that just keeps growing and gets better and better, and if there's more people involved, it can grow and get better faster, as well as be more stable. So the positive cycles are increased, the stability is increased, and as both of those things are increased, then the end result also increases in it, kind of an exponential multiplication type process. It's not like a dollar for dollar increase, it's like a multiples of dollars benefit. So the policy has $25,000 a year premium, and that has a guaranteed outcome or death benefit that grows over time because of this PUA rider, so that it can fund itself even without anybody making any payments. It could still fund itself without lapsing for like 2 years. So it has a lot of leeway. And if we set it up with a 10-month payment, that's some leeway. And if we have this holding device, that's some leeway. So that there's not any chance of it really failing, pretty much. Unless everyone were to fail at the same time. And then we'd all fail anyways, no matter what we did. So anyways, if the whole economy crashed and there was no such thing as money anymore or something like that, that would be about the only way. So let's see. I think I was starting with this idea of paying, like one of my kids paying 0.5%. And what would happen in 5 years if they paid $12.50 a month into this policy? So my son Ruben's 10 right now, and this would be exactly the kind of thing he would be interested in doing, because he loves to save money and he loves to earn money. He loves to be productive, and he loves having things set aside for the future. And so this would fit his ideas of things perfectly, and it would also be rewarding in showing him how cycles like this work. So if he paid for the next 5 years, 10 months out of the year into this policy, $12, by the time he was 15, he would have a spending collateral available to him of between $4,000 and $6,000. and that's enough. He could buy his first car, and then as he paid back in payments for buying his car, which by then he might have a job so he could pay payments towards his car, then that collateral of money would be there for him to purchase, like to pay for schooling, or to pay for a mission, or to pay for other things that, are important for him in his future. So that's just a little example of how it might work for a 10-year-old, but it also works that way for, on a bigger scale. Like Gordon, he could probably put in about $1,000 a month, somewhere between 500 and 1,000 a month. So if you put in 1,000 a month, that's like 40% of the total. That would give him a lot of collateral for. He's going to be going on a mission, so he saved the money for his mission, but he saved an excess, so he's got a whole lot that it could be put to use somehow and be building something so that when he gets home from his mission, he can use it to, start pay for college education, pay for whatever next comes in his life, even, buying a home or something like that. If he were to put aside 40%, let me look what that would add up to. If it were, let me see, I have it written down here somewhere. So yeah, it would be about $400,000 in buying collateral set aside that's a 10-year forecast. So in 10 years it would grow to $400,000 worth of collateral set aside that he could then finance something with. And as he paid that back, he would have it there again to finance something else. That's the whole purpose. So, yep. I don't know if there's anything else I should talk about here. I guess a little bit about my dad. He's planning on putting money into it, but taking it out to pay his home loan, but he would not have a percentage of the death benefit because he would be the one the policy is on, so he wouldn't be around when the policy came to fruition. It would be because of him passing on. So it wouldn't really matter. Whatever percentage that he had managed to pay or pay back would split between his heirs, between whom probably his 5 children. And so money that's not paid back is not too big of a deal in the long run, although he would be working towards that as he finishes paying all that off. Depending on how much time he has, you never know. So, yeah. One more thing at the end, I guess, to close with is this is not about purchasing something. This is about creating a pattern that you can follow that works for the future. It's just a pattern. Like an analogy that I heard recently is with golfing. They showed a picture of Tiger Woods golf clubs that are super nice. They're the best golf clubs in the world. They're shiny. They're all like perfection. And would you rather have Tiger Woods golf clubs, or would you rather have Tiger Woods swing? And that's just to say, it's not the golf club. I mean, of course, the golf clubs, if you don't know how to use them, they don't do any good. And it's the same with the banking policy. If you don't understand the concept and aren't trained in it, don't have the skill level in it, then you're missing the boat. And a lot of people I know that use the banking concept think it doesn't work because they're thinking of it as something you purchase. It's not something you purchase. It's not a product. It's just a concept that makes a difference in people's lives. And in putting a policy on my father, I feel like it makes a difference in his life to really add value. It doesn't take away anything, it just adds value to the fact that he is here, that he's still alive, that there is a person in our life that we can bank on, that we can bring us together to create a synergistic relationship that can benefit everyone. So that's pretty much the power of family that gets me excited about looking into the projections of what this might look like. So yeah, we'll go from there. Hopefully I covered something that was helpful in this little discussion. Thanks. Bye-bye.